October 19, 1987, a date that shook the foundations of global financial systems. A day that caught the whole world off guard, embodying the uncertainty and vulnerability of our economic structures. Today, on a day like this, Black Monday, the day global stock markets experienced a severe crash. Picture this. It's the mid-1980s. The world is enjoying an era of prosperity and financial growth, often referred to as the Roaring '80s. Economies are booming. We see technological growth on a scale like never before. Investors are becoming increasingly confident, riding on the wave of an incredible bull market. Stock prices are skyrocketing, and it looks like nothing can bring down this financial juggernaut. Against this backdrop, it seemed like Wall Street was invincible. This was, after all, the era of the Yuppie, a generation of young urban professionals making quick bucks from the booming equity market. Perhaps for some, memories of the Great Depression were fading into oblivion, replaced with champagne-soaked lunches and evenings of decadence. However, it's crucial to remember that beneath this facade of unstoppable growth were undeniable cracks. Cracks that had the potential to bring about financial disaster on an unprecedented scale. There were telltale signs of trouble brewing in this bullish market. In the years leading up to Black Monday, international disputes cropped up around trade policy and exchange rates. Politicians grappled with how to balance domestic economic needs with global impacts. The regulatory environment began changing across countries as they tried to keep up with the exploding world economy. Let's not forget that this was also a period of financial innovation. Complex, new financial instruments like portfolio insurance were gaining popularity amongst institutional investors. Portfolio insurance was a method used by investors to hedge against market risks. But, in reality, spoiler alert, it was a double-edged sword that ultimately contributed to escalated selling pressures on that fateful day. Couple all this with rising interest rates in the US throughout 1987. The Federal Reserve raised these rates to cool down an overheating economy and keep inflation at bay. However, this meant borrowing became expensive, and people started questioning the stock values. Trust me when I say this was a ticking time bomb. An overconfident market hit a speed bump as the US economy started slowing down with the high interest rates. Then, throwing a spanner into this volatile mix was discord among major economies about their monetary policies. As the global economies intertwined, yet strived for individual superiority and sustainability, the international financial system teetered dangerously on the edge of chaos. The dominoes were set. The tension was building. All it would take would be a small push for the chain reaction to start, a reaction that would lead us to the most crowded selling floor in Wall Street's history in mere moments. As the old saying goes, the higher you climb, the harder you may fall. And indeed, fall it did. But we're getting ahead of ourselves. Let's backtrack slightly in our timeline to a few days earlier on Wednesday, October 14th. By this point, investors across the globe were starting to get nervous. Prices dropped on stock markets across Asia and Europe before even waking up their American counterparts. And when those Wall Street traders did wake up, well, you can probably guess what happened next. As Wall Street wakes up that morning on October 19, 1987, the mood is tense. The clouds of nervous anticipation hang over the eager faces of traders. The opening bell rings, and as trading starts, the initial unease doesn't seem unfounded. The market opens with a massive drop of 300 points in just the first few minutes of trading. A sense of panic starts to spread among investors and traders alike, and there's this collective holding of breath as everybody watches the events unfold. Remember those portfolio insurance strategies we mentioned earlier? Those were supposed to protect investors against a market downturn. However, they ironically started to add fuel to the fire. These strategies required selling more as the market went down, which only pushed prices lower and lower. The selling quickly became a landslide as everyone tried to exit their positions out of fear of a massive loss. There was chaos, akin to witnessing a dozen multi-car pileups all at once. In midst of this chaos, there was confusion. The computers couldn't keep up with increased trading volumes. Out of all days, they chose this day to fail, further escalating the anxiety amongst traders. Trading floors across Wall Street, usually buzzing with activity, were hushed, except for frantic phone calls to clients advising them to sell stock. There was an almost palpable fear hanging in the air. One could arguably taste it. Amidst this frenzy ensued what was later referred to as the flight to quality. This is a fancy term indicating that investors scrambled to pull their money out of the crashing stock market and instead put them into safer securities like bonds and gold. As the clock struck 1 p.m., the Federal Reserve stepped in, scrambling behind closed doors to come up with an action plan. They released a short statement. The Federal Reserve System is today supplying unusually large amounts of liquidity to the financial markets. Basically, they were putting more money into the system to try and stop the panic. But, despite their best efforts, there was no stopping the slide that day. At the closing bell, the Dow Jones Industrial Average had dropped an astounding 508 points. That's about 22%, the largest single-day percentage loss in history. Investors across the globe watched helplessly as the market fell. In one day, some people lost what they'd spent years trying to build. Licenses lost, jobs lost, life savings lost, and a newfound skepticism in the economy was found. But as the dust from this financial catastrophe started to settle, there was one glaring question left behind. Why did this happen? In the immediate aftermath of Black Monday, investigations were launched to understand what had just happened. As the world started picking apart the events of that fateful day, they realized a culmination of factors had caused this crash, not just one single event. Market psychology played a massive role. Individual and institutional investor panic had a snowball effect that went out of control. The use of computers in trading was put under scrutiny. The automated selling due to portfolio insurance had exacerbated the situation. Computers couldn't handle the volume of trades occurring and hiccuped at the most unfortunate time. This was an era where technology had begun permeating aspects of our lives, including stock trading, but it seemed like there was a long way to go before it could make trading foolproof. And while the world was trying to understand what went wrong, policymakers were working tirelessly to relieve the financial distress. The Federal Reserve, under then-Chairman Alan Greenspan, acted as the lender of last resort and flooded the market with liquidity. The aim was to safeguard the economy and prevent a complete financial system collapse, and it worked. Structural reforms were also ushered in. Circuit breakers were introduced to halt trading temporarily in the event of a substantial price decline to prevent a repeat of Black Monday. Nevertheless, the crash left lasting impacts. The crash had global ramifications as well. Markets around the world felt its aftershocks, prompting countries to evaluate their financial systems. Let's not forget, this was during a time when economies were becoming more interconnected than ever before. More importantly, Black Monday changed the way people looked at financial markets. The memories of lost fortunes were imprinted deeply. A sense of mistrust and skepticism toward the stock market lingered for years. For those who lived through it, it served as a chilling reminder of just how volatile and unpredictable markets can be. While it brought about a significant shift in people's perception, Black Monday also led to robust improvements in market structure and trading mechanisms. It emphasized the increasing importance of risk management and financial regulation. And yet, for all its destructive power, Black Monday was a relatively short-lived crash. Unlike the Great Depression of 1929 or the financial crisis of 2008, which spanned years and led to recessions, the global economy bounced back relatively quickly from Black Monday. By the end of 1987, markets had stabilized and economic growth resumed. But that one painful day had done enough to send shockwaves across the world, scars of which can be felt even today as market regulators continue their battle against preventing such a financial catastrophe. Perhaps most importantly, Black Monday gave us all a valuable lesson. Don't get carried away by soaring stocks and prosperous markets. Always remember the bigger picture. Economies are cyclical, and what goes up must come down. As we step back and look at the events of Black Monday in hindsight, it's clear that while it was a day of significant financial distress, it was also a day of tremendous learning. It taught us some hard lessons about the world we live in and the financial systems that govern our economies. At its core, the stock market is a reflection of human sentiment just as much as it is an economic indicator. Fear and panic can often be as big a driver as logic and economics. Black Monday was a stark reminder of how fear can ripple across the world, causing immense damage in its wake. This crash wasn't just about numbers on a trading screen turning red. It was about human stories, a myriad of investors whose lives were radically altered in a matter of hours. It served as a warning to future investors and forced them to understand the risks associated with the stock market better. No matter how unassailable we view our financial markets to be, they too can crash under particular circumstances. Black Monday changed how we approach trading fundamentally. It marked the beginning of a new era where safety nets were deemed essential, where risk assessment became just as important as potential profits. Fast forward to today's world. Many of us can trade stocks on our smartphones within seconds. We have sophisticated algorithms looking out for suspicious activities in the markets and measures in place to prevent massive sell-offs from taking place. Technology has advanced leaps and bounds, and our financial systems are more resilient because of these improvements. Yet, history has taught us that the wheel keeps spinning. Boom and bust cycles are inevitable. The human element of panic and euphoria cannot be entirely removed from the equation. Precisely for this reason, it's important to remember events like Black Monday. It serves as a humbling reminder that even in the face of immense technological progress and stratospheric stock prices, the specter of a possible crash should always be on our radar. In closing, the story of Black Monday is a timely reminder. We are susceptible to the same fears and follies no matter which era we belong to. It underlines the importance of regulation, investments based on informed choices, and most importantly, viewing our financial markets for what they are, unpredictable yet essential mechanisms of our economy. It speaks volumes about our past, present, and lays the groundwork for the future. History, after all, is not just about remembering dates and years. It's about learning from the highs and lows that shape us as a society and move us forward. And there we have it, the journey of a day that shook the world's financial markets from dawn to dusk. Incredibly fascinating, right? I'd love to hear what you think about this significant moment in history. Were you aware of these events? Did anything surprise you? Leave a comment down below, and let's get the conversation started. Don't forget to like, share, and subscribe to never miss on more historical journeys. Thanks for watching, and I'll see you next time for another event that happened on a day like this.